Good morning, ladies and gentlemen, and welcome to this edition of Boutiques on Wednesday. My name is Pierre de Klerk. I'm the MD of Boutique Investment Partners, or BIP for short. We are a sister company to BCI, and I'd like to thank the BCI team for inviting me to host the webinar today. Today, we're joined by Paul Crawford from Fairtree. Paul is the head of Fairtree's fixed income credit capability. He's based in London, and they manage a number of mandates and funds, as Paul will indicate. He's going to speak to us about local and global credit today, and we look forward to his presentation. Paul, you can maybe switch on your camera, if possible. There you go. It's good to have you on the video when you do the introduction. Thanks for joining us, Paul. And I think by way of introduction, many of our investors through our own products at BIP and also through their products that they manage themselves are exposed to credit and credit mandates, and many of them are exposed to your funds. And I think the main question that investors currently have is, given the ongoing economic slowdown in the world as the Fed continues to crank up interest rates, the questions are, and if we reflect on the stress that has appeared around Silicon Valley Bank and the regional banks in the US as an example, and also Credit Suisse, the questions that investors have is, is global credit something that should be avoided for the time being, or should one stay invested? And secondly, how does this impact South African credit? Have we been affected, and how does the situation look for SA credit? So please be sure to also cover that in your presentation. I'm sure you will. Handing over to you. Thank you. Please share your slides.
Thank you very much. Okay, morning everyone. As Pierre suggested in the introduction, my name is Paul Crawford. I'm the fund manager of BCI Income Plus, as well as several other funds. I work at Fairtree Asset Management. And I've got a 25-minute presentation today on the Income Plus fund, as well as some of the points which Pierre so aptly put forward during his introduction. So I've entitled this this presentation today, "If it looks like a duck, quacks like a duck, it probably isn't an anti-tank weapon." So you're all probably sitting there thinking, what the hell is this all about? How can a duck ever be an anti-tank weapon? Well, sometimes you think you have a duck, but sometimes if you look very closely, what you have is something similar to an anti-tank guided missile, or a kinetic energy round, or an unguided artillery missile, or a terminally guided submunition, or a bomblet, or an RPG, or an ID, or a mine. In fact, you might find your duck is a lot more dangerous than what you thought. So in other words, it's only once you go into exactly what a sort of duck is used for that you can see that sometimes somewhere deep in the sort of the description of the asset, of the thing that you have, is something that you're completely unaware of. What's this got to do with credit? Well, obviously this has got a lot to do with what we witnessed of late with what happened with Credit Suisse. So where essentially additional tier one asset holders were written from 100% of face value to zero at the stroke of a pen. So their duck wasn't a duck, it was an anti-tank missile, so hence the analogy. But anyway, okay, so what I'm going to talk about today, I'm going to talk about what we do. I'm going to talk about the most important thing to everyone sitting around today, and that is the scoreboard. In other words, how has the fund performed? I'm going to have a look a little bit more about the Credit Suisse debacle, c'est la vie, or so heißt das Leben, given that Switzerland obviously speaks French as well as German. And then I'll go into a little bit more about additional tier one and what has happened to South African additional tier one, which is probably more poignant to everyone who is listening today. So in other words, who are we and what do we do? Well, I manage a team of 6 individuals, and we manage 16 billion rands in credit and interest rate risk. And we manage this on behalf of multiple different clients of different risk appetites. We run assets in South Africa, Europe, the US, and the UK. So we source assets globally. We manage quite diverse portfolios, from interest rate and credit hedge funds to local only, I'm talking South Africa only credit funds, to international funds, as well as, funnily enough, we run all B funds. So all bond index tracking funds. We do everything in-house, and we are a very quantitative team. So in other words, if you actually look at the individuals that make up the team, you find a lot of engineers, mathematicians, and people that, you know, analyze markets, not from an economic view, but more from a quantitative view. And we pride ourselves in how we actually achieve that. We have a divergent client base that we manage simultaneously within one process. So we again pride ourselves in how we achieve that through our treating customers fairly quantitative algorithms. We are in the process of rolling out our hedge funds to hard currency US dollar equivalents. Again, 15 billion in credit assets and 1.5 billion in hedge fund mirrors. But more about that, we can speak about that a lot later if someone wants to talk. So let's have a look at the quick scoreboard. Paradoxically, even though we've seen, you know, inflation, multi-decade high inflation going back to the sort of early 1980s, and we've seen interest rates being, you know, hiked quite aggressively within the G7, you know, gambit, as well as from South African perspective as well. We still see equities actually, or risk, doing quite well. This is a snapshot from last Thursday at 10:30 in the morning. Everything on the right-hand side, the year to date, if you sort of watch my tracer here, you can see that it's all sort of positive. Some pretty decent returns is had by risk assets as proxied by just general equities. So it's been a great start to 2023. What's happened during the first quarter? Well, STEFI, risk-free in South Africa, or cash, produced 1.77%, which, if we compare that to 2022, a year ago, where rates were some 350 basis points lower, we've seen an extra sort of almost 0.75%. Annualizing these numbers, you can see STEFI itself is going to generate somewhere between sort of 7.75% and 8% for the year, which is, it's going to be a sort of decent sort of return for risk for cash for this STEFI index. Income Plus, during this period, it produced 2.4% during the first quarter, which is, yeah, quite a reasonable sort of return. We're talking just over 60 basis points outperformance of STEFI. Multiply that by 4 quarters, and you've got sort of 2.5% outperformance of STEFI on an annualized basis. So pretty decent sort of returns. The All Bond Index during the first quarter, as you can see, the red line generating sort of 3.42% during the first quarter, but quite a volatile sort of time it's had, you know, up and down. It's been, you know, quite a nasty sort of, not really nasty, but not as smooth as what we'd expect out of the so-called risk-free asset class, which it most certainly isn't. Equities, the star of the show, as it were, so far, producing some 6.22%. Again, we'll talk about this later. Sort of, you know, the second week of March was we're in the furor, the eye of the storm, as it were, with what was going on from Credit Suisse. So you know, quite a healthy downturn followed by a retracement. Yeah. So there we are. When we include the BCI Global Flexible Income Plus Feeder Fund, which is in yellow, you see that actually outperformed everyone. That's due to 2 specific things. One, the rand got absolutely pounded. And secondly, I mean, at the end of the day, global credit did reasonably well. European credit did well, in fact, in spite of sort of Credit Suisse. So at the end of the day, a sort of decent return out of the, you know, global credit in rands, which is proxied by that yellow line. So it actually outperformed equities. When we look at the fund itself over a much longer period, because you're all sitting there thinking, oh, who cares? You know, what is 1 quarter? It's random, for goodness sake. You've said that yourself several times in the past. Yes, I have. The short term is indeed random. So it's pointless like looking at 1 day's worth of performance and then extrapolating a line to sort of forecast 10 years of performance. That doesn't make any sense. So what I've got here is I've got the performance of the fund, the All Bond Index, STEFI, and equities that as proxied by the top 40 total return index for the last 9 years since the inception of the BCI Income Plus Fund. And there's a couple of things that you'll see quite strange about that, those sequences of returns. One is that the green line is steady, that's BCI Income Plus, and a lot more steady than the red, which is the ALBI, and the purple, which is the top 40 total return index. The next thing I want to highlight is that there is a convergence of returns over the long run, which is bizarre in itself. The Income Plus fund over the last sort of 9 years has produced 111.85%. Equities have produced 18.8%. Sorry, 118.8%, excuse me. And the All Bond Index has produced 101.3% return. So almost like a convergence of returns from sort of 101% to 118% is not really a widespread over a 9-year period. If you think about it, you know, let's argue the toss and say that's a big number. I'd argue it's not really that big number. The next thing I want to highlight to you is that all three have outperformed cash. So in other words, there was a risk premium to be extracted in actually taking risk beyond cash markets. So cash produced a sort of 73% over that same period. So all of them outperformed. This is an interesting slide. This is the returns to the different sort of funds as well as indices to the 31st of March, the end of the first quarter. Yeah, I've sort of spoken a bit about Income Plus Fund and how it's done, as well as the ALBI in the top 40. But more interesting is the performance of European government bonds as well as US Treasuries over the long run. You can see, if you follow my tracer here, you can see that literally European government bonds in euros have had a dismal time, as has US Treasuries, by the way. In the last 9 years in US dollars, they've only generated some 11% of performance, which is quite paltry to say the least. iTraxx crossover and iTraxx main are also so, and iTraxx crossover in euros has been again the star of the show. Crossover has outperformed European government bonds handsomely, as well as US Treasuries in their own local currencies. So that's quite interesting in itself. You can sort of take your time and have a look at it a bit later. So global risk-free certainly hasn't offered very much. It hasn't been a good idea to avoid risk-taking. So that's the scoreboard. So let's have a look at Credit Suisse. This is a very, very interesting case, and people will talk about this for years. Not just the demise of Credit Suisse, but also the central bank's response to the demise of Credit Suisse, which arguably has been quite different to what we witnessed some 15 years ago when Lehman Brothers went belly up. So here we are. This is Credit Suisse equity, or their ordinary shares, their common equity in Swiss francs. You can see it sort of year to date, it's sort of been doing nothing. And then comes sort of the second week of March, and it basically fell off the side of a cliff and basically lost literally, 2/3 of its, 3/4 of its value, should I actually say, a little bit more actually. So it just basically fell off the side of the cliff. But this unfortunately hides a little bit more of history, in that Credit Suisse has really never sort of recovered since the global financial crisis. In fact, arguably, considering the global financial crisis happened sort of here, you can see that Credit Suisse was already running into trouble before the demise of global financial markets, and has never really recovered. I mean, in fact, people that suggested it was a good idea to buy the dips certainly wouldn't have much time to get out of late. If you have a look, the last sort of 2 years, we've seen basically a sort of one-way traffic in Credit Suisse share price, which is quite scary in itself. Now, additional tier one, which is, you know, prefs, if you think about them, they've been quite popular in South African funds, which we have avoided almost like the plague since their inception some 20 years ago, 50 years ago in South Africa. Additional tier one, you can see this is the Credit Suisse additional tier one asset, which has literally moved from 100%, at the big end of January, almost beginning of February, to literally zero today. In fact, it is zero. After this, the Swiss central bank effected a full write-down of these additional tier 1 assets on the 19th of March, after they had reached their point of non-viability. All of the additional tier 1 was basically written to zero. So yeah, people that thought they had a lame duck, as it were, that had no sort of, it was walked like a duck, talked like a duck, looked like normal credit, worked like normal credit, but was actually equity. In fact, worse than equity, because this additional tier 1 was written to zero, whilst Credit Suisse shareholders were offered 1 UBS share for every 4.78 shares that they owned of Credit Suisse. So effectively, the additional tier 1 subordinated ordinary equity during this entire process. So again, the duck was actually an anti-tank missile. So if we have a look at the global contingent convertible total return index, this is an index that tracks the performance of additional tier 1 assets. You'll see that the debacle of Credit Suisse led to an almost 17% write-down of the index. It has recovered somewhat, but remains quite far from where it was a month previous. So we're still a little bit far out the woods as of yet. So why do I go on about this? Why is Credit Suisse such a story? Well, you know, Credit Suisse is not a small bank, and I just want to show you how big it actually is. This is Credit Suisse in rands. So I've converted the Swiss franc share price into rands and then multiplied by the free float, and I get to its basic market cap in rand billions. So you can see it's sort of moving around some sort of 400 billion to sort of 650 billion over this time period from 2000 up until now, where literally it's been marked down from zero. If we then look at the South African banking market cap as proxied by Standard Bank plus ABSA plus Nedbank plus FirstRand, the sort of big four, we get this in orange. And you can see that it wasn't that long ago when Credit Suisse itself was bigger than South African Banking Inc. So we're not talking about a tuppence halfpenny tiny little bank which has just failed. We're talking about something that not too long ago was the size of the South African banking market. So when we talk about Credit Suisse, please do not think it's some little trading bank that doesn't mean anything. It's a sizable entity. In fact, Credit Suisse has been found and still is, this is the paradox of everything, is that it still is in the iTraxx main index, which is 125 investment grade names. So it has been in the iTraxx main since Series 10, which is some 15 years ago. The interesting thing is that it's also in the MSCI ESG Screened Europe Index. So it's, the good news is if you had lost money, you've at least lost green money, as it were. This is ESG Screened Index. So it certainly conformed to the requirements to ensure social governance, as well as it looked after the environment during this demise. But I mean, at the end of the year, at the end of the day, it still has sort of seen its backside, unfortunately. So what have we all learned? The first thing is that nothing is too big to fail. You know, Credit Suisse went belly up, and it went belly up rather quickly. The second thing I want to highlight is everything was indeed obvious after the fact. If you look at it, you know, everyone will tell you how obvious this was. Yeah, well, yeah, it's the majors in the US. If you think about the PIMCOs, if you think about the Black Rocks, the large asset management managing trillions of dollars, they were caught by this. In fact, they are trying their utmost to sort of challenge what happened in the courts. I think that is just going to add to more losses rather than getting their money back from the Swiss banks. Swiss banks have traditionally been quite closed when it comes to, you know, you bearing all and being transparent. I mean, let's face it, yeah, they don't have a history of opening up their books, as it were. The most interesting thing about it is that Credit Suisse ceased to exist without defaulting on any of its obligations. In fact, none of the CDSs were triggered, which is why it's still in the investment, it still remains in the investment grade indices. It hasn't defaulted on anything. As I said, it's not a small bank. It was bigger than the South African Big Four not that long ago. What we've also learned is that additional tier one is tier one equity. It's not common equity tier one, but it's tier one which makes it equity. And it exists at the behest of the central banks. The central bank can do as they please with it. But just remember that the central bank retains a wild card option on how these instruments are, you know, whether they exist or not, or whether they're able to be financed or not on their call dates. So we must always be careful of it. The additional tier one went to zero. And as everybody thinks, this will never happen in SA until it does. Banks never fail in South Africa. Well, unfortunately, they do. I can point to several banks in South Africa that have failed. And in fact, there's one right now that's in the process of failing. It's defaulted in its obligations. It's the Land Bank. So not only is it a bank, but it's a bank which is fully owned by the government of South Africa, and it is currently still in default. So let's have a look at additional tier one. It's something which we own very small portions of. Nothing that we would say is ever uninvestable. We'd always argue that everything has a price. This is the Credit Suisse CDS spread, which you can see during the debacle moved from roughly about 350 basis points to over 1,100 basis points. And then after the takeover by UBS, sunk back to 200 basis points. So it has, you know, sort of moved much higher than came back again. This is something which we do have. And this is the Investec AT1 perp in pounds. And you'll find this in our funds. You can see everything looking all fine and dandy as a spread until March the 15th, and then spiking up from roughly about 650 basis points to over 1,500 basis points of spread. This is Investec. This is in pounds. This is instruments which are marked to market properly. So you can see Investec, the 5th largest bank, has suffered some stress thanks to contagion of the Credit Suisse debacle. ABSA, on the other hand, this is its AT1 perp in South Africa. I'm just showing you one right now that was issued in November last year. It was issued at a JIBAR plus 351 basis points, somewhere akin to what you get when you invest in the BCI Income Plus fund, by the way, round about JIBAR plus 340 basis points, same sort of number. Remember that number, 354 basis points. Here's where their spreads are right now. This is as of the end of March. So according to the market prices which are produced by the JSE, that the ABSA group tier one, additional tier one instruments were marked somewhere between 154 and 340 basis points. So whilst we witnessed the meltdown of global credit, what happened in South Africa? Nothing. No one cares. Tier one, additional tier one remains intact. So all of the perps didn't move. ABSA perps in euros, however, sorry, US dollars, however, moved up quite prestigiously. From a low in February of around about 370 points, almost doubling to 650 points at the end of March, coming off a high of some 725 basis points. So quite a large move in its spread over that period. This is, of course, in global markets where mark-to-market is very important. I've highlighted ABSA. I can say this for all additional tier one in South Africa. This is Standard Banks. I'm just showing you this as well. Again, the spreads ranging from 188 basis points to 343 basis points. And this is as of last Thursday. So the aberration, the contagion certainly hasn't come to South Africa. Whether it should or not, whether risk is a global concept or a localized concept, that is another story. I mean, you know how I feel about this. Risk is risk is risk. You source it in the best place where you're priced appropriately. So in other words, I will source additional tier one, not in rands, but I'll source it in euros, pounds, and US dollars, where I'm getting adequately compensated for the inherent risk that I'm taking. So in conclusion, the BCI Income Plus Fund has delivered over the long term. I showed you the 9-year charts of the BCI Income Plus Fund, the convergence of returns between it, equity, and the all bond index. That makes BCI Income Plus a cornerstone building block for most portfolios. You've seen that the volatility of that trace, which I showed you earlier on, was significantly lower than what you would have seen within the all bond index or equities. So you're getting good returns at incredibly low risk. You are getting risk. I want to highlight that. Nothing comes for free, but the bottom line is significantly lower realized risk than what you'd have had in the all bond index, as well as the top 40. My team is, we have multiple solutions. Again, we're talking OBI replication, we're talking interest rate hedge funds, we're talking credit hedge funds, we're talking local only credit, we're talking global credit. We have multiple solutions depending on the client's risk appetite. Not my risk appetite, the client's risk appetite. The major casualties in the Credit Suisse debacle paradoxically weren't the common equity holders. They are now running around with freshly printed UBS shares in their back pockets. The real casualties were the additional tier one investors who literally seen their 16.5 billion Swiss franc investments go to literally zero. Yeah, so they were the major casualties. Next point, Credit Suisse did not default in any of its debt obligations. Paradoxically, this entire debacle arguably was caused by equity valuations. So in other words, it was equity vigilantes that drove this Credit Suisse into its current position. The equity went to close to zero, which caused the Swiss Central Bank to smooth over things by insisting that UBS take it out, which they did. This stopped global financial contagion so far, as we witnessed way back when Lehman Brothers suffered a similar demise in 2008, and we don't have some global financial contagion or global contagion going on. So European AT1 has been hit hard. I showed you that. I showed it to you. South African banks in pounds and US dollars have also been hit hard. They've seen aggressive selling, remarking of that risk. Unfortunately, in South Africa, we have not witnessed the same thing on the same balance sheets, which is quite interesting in itself. So what are we looking for with the fund? Well, the fund itself, the Income Plus Fund, currently spreads 335 basis points to JIBAR. So our expectations over the next 12 months of the returns or the prospective returns of the BCI Income Plus is somewhere between 10.5 and 11.25%. If you have a look at the 12-month trailing returns from this morning, you'll see the BCI Income Plus has delivered 8.44% return over the past 12 months on a post-fees basis. That's obviously with rates significantly lower than where they are right now, run about 175 basis points. So you can see it's certainly well within the realms of possibility to generate, somewhere between 11.25 to 10.50 in this fund over the next 12 months. And that is my presentation complete in exactly 30 minutes. Are there any questions?
Thank you, Paul, for some very interesting insights as always. I've got a number of questions. I think to start off with, loop back to the initial question I asked, and let me push you for a straight answer. Given the risk of a recession looming somewhere in the next year or year and a half, is global credit and credit generally speaking something to be more careful of than usual, or should one just kind of sit it through and look through it?
It's a very good question. Look, at the end of the day, it's not about what's coming, you know, what's coming economically. It's about what isn't priced. That is what really matters. What is the market pricing in? You know, are we pricing in sort of, you know, earnings falling to almost zero and companies, you know, defaulting and that sort of thing? And the response is yes, credit spreads have widened, but they've widened to compensate for that possibility of, you know, an increase in default experience. Remember, iTraxx crossover itself is sitting in the realms of 450 basis points right now. If we turn back the clock to the end of 2021 going into 2022, iTraxx crossover was around about 210 basis points. So we've seen a doubling of the credit spread, which essentially is more than compensating you for the possibility of that default experience increasing somewhat. So I would think markets are pricing an increased default experience. Remember, the last time we've seen a significant default globally was in September last year, and that was a US-based firm. So we haven't seen this sort of expectation, or we haven't seen the realization of the expectation of an increase in default experience. If you recall, it was during the third quarter of last year that actually rang the bell and said, oh, it's actually time now to start risking up. And that's what we basically started doing. That's when iTraxx itself was at over 700 basis points. So we have seen a fantastic rally over the last sort of 6 months, you know, the fourth quarter of 2022 and the first quarter of 2023. So we have seen, let's call it the easy money having had been made within global credit. But that does not suggest that suddenly, you know, it's going to be terrible times for the asset class. I would suggest that we're still looking at, you know, when you include risk-free, which is certainly, you know, if you talk about Euribor at sort of 3%, you add sort of 4% to that, you're talking 7% returns, prospective 7% returns in euros, which is pretty punchy, you know. So it's certainly not time to run away. It's certainly time to consider how you see global credit fitting into your portfolio. And I would always argue that there is certainly a space for global credit, specifically when we start talking sort of sub-investment grade rather than investment grade. That's where I would be fishing. If you consider South Africa itself as a sub-investment grade country, it's sort of pointless investing in risk-free assets when you're in a landscape which is sub-investment grade anyway. You know, you like for like, you know, that's what I would suggest.
Thank you for that. The last bit of your answer leads nicely into the next question I want to ask, and I want to turn to the main mandates that you manage for us, being the local BCI Income Plus Fund and the global Income Plus Feeder. And obviously the one is predominantly local, the other one is global. But can you please give people a sense of the nuances of the differences in approach with those two products, if any? I think that's important. And as a second part of the question, how should investors think about the products, for example, if they use both of them in a portfolio construct? You know, does it compound the risk unnecessarily, or is it quite viable to use them together?
Yeah, look, I mean, the BCI Income Plus Fund invests in the feeder fund. It's very important that everyone realizes that. But it invests and then hedges currency. The feeder fund does not hedge currency. It has a naked euro position, which has driven a lot of the performance of late. Let me just tell you, the demise of the rand over the sort of last 18 months, well, effectively more importantly, so over the last sort of 6-7 months, the demise of the rand is what's driven a lot of the feeder fund performance, because it's unhedged, which has it's delivered punchy returns, but at currency type volatility, which is yeah, it's not for everyone's palate. I mean, we hedge all currency risk within the BCI Income Plus fund, because we found that's what clients want. You know, yeah, who am I to decide what clients want and what they don't want? They want a stable stream of returns. And you cannot get a stable stream of returns if you're taking currency risk. It's as simple as that. You know, you have to hedge that currency risk. As far as is it very, so the main difference, what I'm actually saying, is that BCI Income Plus not only has got a very, you know, it's got smallish exposure to the feeder fund itself, but it takes that feeder fund exposure, then it hedges out the currency risk. So that's the first thing. So, and then the second thing that I want to state, and this is very, very important, is that both funds are managed within the process. So the risk appetite depends on what or how we allocate the purchases of assets that we do are actually tuned to the risk appetite of those funds per se, and that's proxied by the spread targets. So at the end of the day, we look at the deviation from where they are relative to their targets, and then size appropriately given the makeup of the entire portfolios. So both are managed within the same construct. So it's not that we manage the feeder fund one way and the BCI Income Plus another way. They're managed exactly the same way. The assets that you find within the feeder fund, they're not exactly the same, but quite similar to the assets that we find within the BCI Income Plus fund. I hope that answers your question.
Thank you. That's insightful. Another general question about your approach. We spoke in the presentation a lot about spreads narrowing and widening under different conditions and so forth, which is perfectly normal for the credit market. So maybe talk a bit about how investors should think about mark-to-market losses, let's call it non-crystallized losses, versus a hold-to-maturity philosophy or approach, or aspect to those investments. How should they deal with the short term? Think about the short term.
This is a great question. Okay, right. So, you know, economically, mark-to-market risk and default risk are exactly the same thing. There is no difference. They're exactly the same thing. The only difference is how you deal with mark-to-market losses compared to permanent default losses. If you sell out thanks to mark-to-market risk, you're crystallizing losses, almost crystallizing a default, even though those defaults have never existed. That is what you're doing. You are selling assets which have been written down. That's what you're doing. And those write-downs might be akin to default or recovery amounts. So you're effectively you're almost like defaulting the assets, because you're selling them at those depressed levels. That is what you do when you do not write out mark-to-market. You are crystallizing losses almost like defaults, which are the crystallization of losses when defaults occurs and you get recovery. So technically speaking, they are the same thing. But it's how you choose to deal with those that really matters. How you choose to respond. We have always said that we do not have a crystal ball, and we will continue to bang that drum, and we'll continue to bang the drum that no one has a crystal ball. So no one can forecast the future, and no one can do it consistently. And everyone reminds you of the 2 things they got right, but don't like to tell you about the 17 things they get wrong. Everyone listening should be aware that the default experience is something which comes part and parcel with credit risk. It's almost like expecting, you know, not to have downturns when you invest in equities, only upside. It's just rabbit. It's just impossible. I wish that existed. It doesn't. In fact, yeah.
Thanks. Well, sorry for cutting you off, but we've got some great questions. So I want to make sure we get to as many of them as we can.
Sure.
Another question is, what is the link? And I suppose the person asking the question actually means, what's the correlation between the investments in your portfolios and what might go wrong in global property markets? And I think that's an interesting question, because many investors will have credit exposure, but they will also have a global property component and a local property component. So, you know, yeah, where does the risks lie there from a correlation point of view?
Well, I mean, right. Okay, right. So if you consider credit from a globular sort of perspective, no, I hope this answers it, by the way. If you think about credit from a globular perspective, and when I say globular, I'm not talking about the globe, I'm talking about sort of the universe. What is it? We lend money to companies that take that money and go and invest in assets. What are those assets? It could be a manufacturing plant. It could be a company that makes transformers, for example. It could be a company that makes cars. It could be a company that, you know, produces widgets which are then sold in the retail market. It could be a clothing company. It could be, there's all different types of things. So when we talk about credit, we're talking about everything, literally all types of companies, a well-diversified pool of underlying assets. When we talk about property, what are we talking about? We're talking about property. So effectively, it's almost like a one-lever credit portfolio, which only invests in companies that build houses or rent out retail space. At the end of the day, it's one type of asset, I would argue. So yeah, the diversification benefits of both are quite different. I just want to say that. So a good, well-diversified credit portfolio should offer a lot less volatility than a property sort of portfolio. The next thing the very last thing I want to say about it, property is just long-term bonds. That's all it is. It's just ultra long-term bonds. So when you invest in a property, you have an asset that produces a stream of fixed coupons, which is then discounted. That looks like a normal vanilla bond to me.
Thanks, Paul. Just moving back to the local BCI Income Plus product, what is the current global exposure via the feeder fund in the local product? And do you foresee that changing into the future with respect to the Reg 28 changes, but also just generally your view on the global portion that you want in that portfolio?
Well, we are essentially almost maxed out on global credit. So when we include the inward listings as well as our external direct investments into the feeder fund, we are literally almost maxed out. So yeah, so when would we be increasing that? Well, we would increase it with increased flows. So let me just say that. So, but it's not that we are going to quickly go and take another 10% of our assets in global credit, because we can't. We will be at odds with BN90. So yeah, should we be maxed out global credit? Bloody without doubt, for goodness sake. I showed earlier on that just, you know, Investec additional tier 1 and ABSA additional tier 1 trades at discount, you know, to what you can get from a rand perspective, and that's in hard currency. Think about that. Same company, higher yield in hard currency. It just looks quite attractive when I look at it that way. Look, for everyone in the room, sorry, I must be careful because there's probably quite a couple of banking analysts in the room. A couple of bank analysts in the room will say, yeah, but that's That's because if you look at PEs of South Africa's PEs of South Africa, the South African banking market trades at a premium to the average PE of the European banking market. So it should have lower yields. And I don't really have a response to that, to be honest. If you think about, European banks trading at lower P's in hard currency to South African banks in rands, and they have higher P's. It's quite an interesting dilemma.
Thanks a lot. I'm going to push that we're a minute over time. We're going to push it for another minute or two. There's another question that asked about the attractiveness of EM credit. And I think what I can add to that is, just last night, I read the newsletter from GMO with their 7-year return expectations for global asset classes. And they are very positive about EM asset classes, equity as well as debt compared to DM. Is that something you'll be looking at in future, or do you see the SA exposure as filling that bucket to the brim?
Thank you very much. That was exactly my response. I'm actually glad to hear that, is that EM is going to do well, and even for BCI Income Plus's sake, which has approximately 63% exposure to EM, i.e. 63% exposure to South African credit assets. I hope that's the case. So that's quite good news. Look, so again, I'm always, thank you. I'm always wary about it's like I constantly get this question: why don't you invest in other Africa? Because there's some great opportunities in Ghana, Nigeria, and I listen to them and I think, goodness gracious, last time I looked, South Africa is Africa. So it forms part of the continent. The correlation between South Africa and countries within Africa, I would argue, just geographically, is higher than what it would be from us in South Korea or other places in the Far East, for example. So I think that from a diversification viewpoint, it's better to sort of get out of EM and into DM, because what happens if EM, if that factor comes unstuck? Well, you don't want all your eggs in one basket. We sort of know that. So it's the only sort of free lunch you get in finance, is that diversification is a sort of good idea, and you make money out of diversification. So funds like the BCI Income Plus will take their offshore exposure predominantly in European, US, and UK based firms for the diversification benefits it offers you. It will not start looking at Brazil, India, China, Russia, although they are quite good friends of South Africa right now. We will not be doing that. I just can't see the reason. Why don't I rather just invest in more South African assets rather? At least I know those companies a bit better.
Good point. Paul, thank you very much. It was a great discussion. Thanks to the participants on the call that stayed so long. We actually 3 minutes past, quarter past. So it was a really good call. We've got some more questions we didn't get to. We'll send them to you, Paul, if you don't mind. Then we can get the answers and circulate those. But once again, from our side, thank you very much for the solid performance that your products have delivered for our investors over the many years. And thank you for always being helpful when there's questions and being prepared to speak to us. We value the good access we have to yourself and to Fairtree. Thank you very much for that, and have a great day, everyone.
Thank you very much, Thea. Thanks, everyone, for listening.